Welcome back to the deep dive. And look, if you've spent the last 72 hours just trying to reconcile all these contradictory market signals, well, you are definitely not alone.
Oh, not at all. The tension is palpable.
Right. We've just navigated a really critical FOMC meeting, watched the market take one look at the Fed and immediately pivot, and now we are staring down these wildly conflicting forecasts from some of the biggest names in the game about how 2026 is actually going to unfold.
And that's exactly why this deep dive is so necessary. Our whole task here is to sift through all that noise, the price action, the commentary, and pull out two things for you. First, the distilled macro facts about liquidity right now.
And second,
a clear look at the two diametrically opposed scenarios being painted for crypto's path into 2026. It's really a fight for the future narrative.
And we are jumping right in. Our focus today is laser sharp. First, we have to understand the immediate fallout from the Fed. What did they say? What did they do? And why did the market basically yawn?
Then we'll track where the money is actually flowing, because it is flowing somewhere.
Which involves a massive rotation into hard assets. And finally, we'll break down the great 2026 debate. Why are Ben Cowen and Tom Lee standing on opposite sides of the street, predicting either a slow, grinding winter or a full-on supercycle boom? Okay, let's start right there where all the action was supposed to be. The Fed. They delivered the expected 0.25% rate cut. That pushes the federal funds range to 3.75%.
The expected move.
Exactly. On the surface, a rate cut should be bullish, but if you were watching the charts, that quick crypto spike just faded almost instantly. So why the reversal? Why did the market discount that cut so fast?
It was entirely about the commentary. The market is always forward-looking, so while the cut itself was priced in, Chairman Powell's tone was deeply cautious.
He wasn't exactly celebratory.
Not at all. He didn't give a mission-accomplished speech. He explicitly noted that even though the job market is softening, maybe even more than they expected, core inflation is still way too high, especially in sticky services and wages.
Which is just a terrible policy dilemma for them, isn't it? Because he has to sound confident, but the data itself is contradictory.
Precisely. And his constant repetition of one meeting at a time, no preset path, that signaled that the next cut, say in January, is absolutely not guaranteed. He even suggested policy rates are now near what they consider neutral.
And if policy's already neutral,
it severely limits their ability to cut further without triggering a much larger recession. That uncertainty is why the market reacted so fast. Plus, you had two members vote against the cut. That shows real friction inside the board.
And the market's reaction was brutal. The odds for another cut in January just slumped. I think they fell to around 18% almost immediately.
They did.
But here's the detail on the sources that really caught my eye. Powell was cautious, yes, but the Fed also announced a surprise injection of liquidity. A $40 billion plan to buy Treasury bills starting mid-December. That sounds like a gift to the bulls.
This is where we need to be really clear for you. This is fresh cash, no doubt. But it is T-bill buying. That is not the same as traditional quantitative easing, or QE.
Okay, break that down.
So QE, that's when the Fed buys longer-term assets, like long bonds. That directly pushes down interest rates for things like mortgages and corporate borrowing. It's aggressive stimulus. T-bill buying, on the other hand, is all short-term assets. It's usually a technical move just to make sure the financial system has enough short-term cash to run smoothly.
So it's more about operational stability than economic stimulus.
Exactly. So if I'm a bull, I'm looking at that $40 billion in fresh cash coming in, and that's reversing years of them draining liquidity. But if I'm a bear, I'm listening to the chairman explicitly warn that more cuts are going to be difficult and that inflation is sticky.
It perfectly captures the split.
And we can't forget the end-of-year mechanics that are just making things worse on the bearish side. Tax loss harvesting.
Right. Everyone's selling their losers before the deadline.
Many investors, especially in crypto this year, are selling off assets that are down just to lock in a tax deduction. This isn't selling based on fundamentals. It's a tax strategy.
Yeah.
And when everybody does it at once, it just creates this huge selling pressure and ensures December stays choppy.
That makes a lot of sense. It helps explain why, even with fresh liquidity coming in, that selling pressure is just overriding any bullish signal. So if investors are harvesting losses in crypto, where is that capital going? Where is the real momentum right now?
The rotation is massive, and it is going directly into hard assets. Silver and, more importantly, gold have been incredibly strong for weeks. Gold is decisively outperforming Bitcoin and the whole crypto market.
People are looking for something tangible.
They're looking for a reliable hedge against central bank ambiguity. which is exactly what we just saw in Powell's conflicting statements.
And for our listeners who are into the charts, this rotation is technically pretty significant. The BTC to gold ratio chart. It looks extremely weak on the weekly time frame. It formed what technicians call a large head and shoulders pattern.
And just to put that simply for you, the head and shoulders is a classic reversal warning sign. Basically looks like three peaks, a small one, a big one in the middle, and another small one. It indicates a strong uptrend is running out of gas and often leads to a sustained downturn.
And the fact that Bitcoin is forming this pattern against gold
Is a very clear sign that the market sees gold as the superior safe harbor for now. The flight to quality is real. We expect gold to keep outperforming BTC right through December, riding that wave of uncertainty.
The good news, I guess, for more sophisticated traders is that some platforms are making it easier to trade this theme.
Right. Platforms like Lighter and Hyperliquid are now offering simple, direct ways to play metals right alongside your crypto.
So, okay, we have macro caution, we have retail rotation, but what about the institutions? While the public market is dealing with all this price softness, what are the big players doing behind the scenes?
There's a lot of hidden positioning going on, and it tells a very, very different story. You can start with Tom Lee's firm, BitMine. They just added a stunning $112 million in Ethereum.
Wow, that's not a small trade.
That is a high-confidence structural commitment. And Lee himself said that he believes Ethereum has already bottomed. He's predicting a massive supercycle reversal starting in early 2026, driven by the very macro factors Powell is struggling with right now.
That's a huge move, totally divorced from the current price action. What could he be seeing that gives him that kind of confidence?
He's looking past the daily volatility and focusing on adoption infrastructure. You see similar moves in the regulatory space. In the UK, the Financial Conduct Authority, the FCA, is now prioritizing stablecoin payments for 2026.
They launched a sandbox, right?
Exactly. A regulatory sandbox specifically for UK-issued sterling stablecoins. When a major financial jurisdiction starts building sandboxes for regulated digital currencies, it signals that long-term structural adoption isn't just coming. It's actively being designed right now.
We're also seeing institutional access expand into some really interesting niche sectors. I saw Grayscale just launched the Bittenser Trust, GTAO.
Which is now publicly trading on OTCQX.
Yeah.
And this is significant. It gives traditional U.S. investors their first publicly quoted exposure to the AI-focused TAO token. And think about the timing.
Right before its first halving.
Right before its first supply-reducing halving event. Institutions aren't just buying Bitcoin anymore. They are targeting high-growth, utility-focused tokens right ahead of predictable scarcity events. They're being strategic, not reactive.
And speaking of strategy, Binance just updated its infrastructure for the whales. They introduced a private indication of interest system, an IOI system.
Yeah, the IOI system is crucial for understanding how institutional volume works. It allows traders moving $200,000 or more to signal large spot and loan interest privately.
So they don't move the market with their orders.
Exactly. They avoid disrupting public market prices.
Right.
You can think of it like a silent auction for whales. They're positioning, they're acquiring massive inventory, and we, the public, only see the delayed effect of that volume after the fact.
So it's clear that while retail is debating the day-to-day price, the smart money is quietly building huge long-term positions, which of course brings us to the core conflict.
It does. We have this strange dichotomy. You've got fresh liquidity and major institutional positioning on one side, versus cautious central bank language and weak price action on the other. This is the bedrock for the great 2026 debate.
You've got two extremely prominent, respected analysts, Ben Cowen and Tom Lee, with completely opposite predictions.
Which raises the big question. Is this quiet accumulation a sign of strength? Or are these institutions just positioning for a brief relief rally before a very deep winter?
Okay, let's start with the bear case. This is from Ben Cowen. Cowen believes the market is simply entering its predictable winter phase, following the historical diminishing returns we've seen in past cycles. He argues the high point already happened.
And he has a controversial name for it, the apathy top.
Well, apathy top, what's the concept there?
It's a fascinating idea. It rests on the theory that the bull cycle peaked in late 2025 without the usual retail euphoria. No mainstream news headlines about people quitting jobs to trade crypto, no crazy leverage from new money.
And because the market never got overly excited.
He argues there isn't a mountain of leveraged retail capital to liquidate violently. So instead of a dramatic fast crash that wipes everyone out, you get a slow, grinding fall, a bleeding out that just drags on sentiment for years.
That sounds almost worse.
It can be. His outlook stresses that altcoins will struggle massively because the Fed is still restricting cash flow in the broader system. BTC, he says, is the only safe blue chip to hold during this cold period. And crucially, he warns people not to get trapped by the sucker's rally.
The classic bear market trick. What's the mistake people make there?
The mistake is believing the low is in. Cowen predicts we'll see a brief, sharp recovery in early 2026, a dead cat bounce. And it convinces exhausted investors the bear market is over. People jump back in only for that rally to establish a lower high.
And then the slow decline continues?
It continues. It just traps investors and prevents them from getting out. His strategy is clear. The market needs to cool off completely. The only real fix powerful enough to restart what he calls the animal spirits for a new bull run is aggressive Fed rate cuts.
Cuts that are deep enough to signal a major recession or real macro pain.
Right, and he suggests that might not even happen until mid to late 2026. So for him, the strategy is high conviction patience. Save cash, wait for that pain to force the Fed's hand, and then buy strong assets like Bitcoin at rock-bottom prices later in 2026.
So for him, the next 18 months are an accumulation zone, not a performance zone.
Exactly.
Now let's jump straight over the fence to the bull case led by Tom Lee. He completely rejects this idea of a cyclical winter. He argues the market has entered a rare multi-year supercycle.
Right, a sustained boom driven not by hype, but by fundamental, irreversible changes in financial institutions and government policy.
So he sees the very forces Cowen is worried about, the institutional involvement, as the primary engine of growth.
Precisely. He points to evidence like PNC, the sixth largest U.S. bank, now allowing its richest clients to trade Bitcoin directly. He says this proves the elites aren't just watching, they're embedding crypto into the traditional financial system. That structural shift just wasn't there in previous cycles.
And unlike Cowen, who sees the Fed as restrictive, Lee sees their current moves as rocket fuel. That rate cut, combined with the Fed buying treasury bills and injecting cash, that's traditionally the starting gun for aggressive risk-on behavior.
Especially for scarce assets like Bitcoin and Ethereum. He believes the old cyclical patterns are broken because of this institutionalization. And his strategy is anchored in his famous never sell rule for high-confidence assets. This isn't a trade, it's an investment in a structural overhaul.
But with all this volatility, how can anyone stomach a never sell rule? What about preserving capital during those major dips?
Lee sees that volatility not as risk, but as opportunity. He compares price dips to a gift. It's like getting a discount on a stock like Nvidia after a strong earnings report. The dip doesn't change the long-term thesis, it just lowers your entry price.
It's a different mindset entirely.
A completely different mindset. And he's also encouraging investors to watch the privacy trend in crypto in 2026, noting that utility in that sector is due for a major institutional breakout.
So what does this all mean for you, the listener? We have liquidity secretly entering the system. We have institutional validation happening behind the scenes, from BitMine's huge bets to Grayscale launching trusts. Yet there's this huge structural split on whether this is a boom or just preparation for a long winter.
The core strategic choice facing you is whether to follow Cowen's advice, exercising supreme patience, waiting for that deep macro pain to create a definitive bottom, and just saving cash, or to follow Lee's advice, which is treating every single dip as an investment gift based on structural adoption and first liquidity.
So here's the final thought. Given that one perspective hinges on the Fed's need for aggressive cuts to signal a true bottom, and the other hinges on the Fed's current liquidity injection being rocket fuel, how long can the U.S. central bank sustain these conflicting signals, weak labor and high inflation versus quiet treasury buying before one narrative has to win the war for market sentiment? That's the macro question that will define your 2026. Something for you to chew on as we head into the new year.